I think you got to start with terminology, right? The word recession, right? I would argue there are tons of people, percentage-wise, I don't know what the percent would be, but it's a very high percentage in the United States right now that would tell you, I'm working 2 jobs, my wife's working a job, we only net an additional $100 with her working after we put the kids in childcare or whatever. So how do you define recession? How do you define just sheer economic pain for the common person who's just trying to stay alive, that's been working for 30 years of their life and they only have 40% paid off on their house? It doesn't make any sense. You could go out into the woods for 30 years and cut down trees and you have a damn mansion if you made it by yourself, right? So like, people aren't asking themselves like these really simple, basic, core ideas of, if I work my tail off and I have nothing to show, I'm a debt slave. I'm a debt slave. And it's a function of this highly like manipulated system of how they're controlling the money, how they're inserting the money, how they're controlling interest rates. And because people aren't taught any of this stuff in school, they don't know any better. They just think it's normal because they've been dealing with it. They've been dealing with the slow grind decline in their ability to afford anything their whole lives. And so it's worn them out. They don't even understand where they're at. So like, how would we even define recession when we're dealing with this juggernaut of reality that the common person is dealing with on a daily basis? Are we measuring it based off of the stock market that 1% of the global population pretty much owns all the equity of? Is that what we're basing it off of? Because if we are, like, we're so off the grid of reality for the everyday person that's participating in this economy.
Yeah, and the concept of moral hazard too, where go back to your PE multiple example on the S&P 500. I think there's an implicit assumption from everybody buying the S&P that if something horrible goes wrong, the bazooka comes right back out and they've got my back. They're not going to let it spiral. And I go to conferences, I see other kind of buy side investors, and I'm on the younger side. I'm 39, but I see a lot of younger people than me in these rooms, and they just kind of have this mindset that if something bad happens, I'm going to get bailed out, so I can take this risk that isn't really commensurate with the fundamentals. And by my background, I'm kind of unique, even though I'm younger for kind of being a PM, because one, my family's business was hospitality down at the New Jersey shore. And as a really young kid, I saw my parents get the keys taken away on their businesses during the savings and loan crisis. So understanding if you're over levered and you have a cash flow and duration mismatch, keys go away. It's funny. This is actually a funny story. I was talking to my boss and looking at buying a house after the pandemic. So I had to get out of New York City with little kids. And I said, Peter, do you think it's reasonable? You get, I know they have all these ratios of what they'll lend to you, but I think it's reasonable to have 10 years of mortgage payments in the bank is a reasonable buffer that you can afford that house. And he starts cracking up. He's like, James, nobody would buy a house. Are you out of your mind? But that moral hazard doesn't exist. Like all these people running around that started their career post '08. I was also, very young at Horizon. I started in '05, saw the rug getting pulled out in '08. But everyone else who basically started or didn't have really a role where they were managing and exposed to risk before '08, they're just like, look, they've got my back. They're going to make everything better. I have nothing to worry about. So, and you see it where risk premium is priced.
Everybody's turned into Pavlov's dog. And they think that when, the bell, when the market's starting to crash, it's like, where's the Fed? They're in a panic. Where's the Fed to save me? Right? We need the Fed to save us. Like, and they do, because if the Fed doesn't come in, if the Fed doesn't come in, everybody's effed. Yeah. Right. And so, it's interesting because everybody, they look at the existing system and they say, well, this is how it has to be. This is how it has to be that this this savior sweeps in and prints a bunch of money and jams it into the hands of the select few, and then whatever trickles down. That's for them to figure out. That's for the peasants to figure out. And that's the problem. Is this has been normalized. This is what people think this is how they think the world should function and how it should go around. And what they failed to realize is that this is a form of debt slavery. Like, you are not getting out of this. Like, if you think you're going to work harder at the bottom of this, and if you have a startup and you're one of these 1% people that can create value for the first time that the big boys haven't already created a value stream and captured all that equity, well, congratulations, because that is a really, really difficult thing to do in this type of environment at this point in time. Now, 20, 30 years ago, it was different. You had a lot more stability that was happening from a currency standpoint. But at the end of these really big credit cycles, the fitness required from an entrepreneur to outswim the debasement current, is so unprecedented that I don't think people realize what they're up against when they're trying to do a startup without some type of massive venture capital entity stepping in and just funding the hell out of it.